Imagine spending years studying stock charts, analysing financial statements, and following expert predictions, only to discover that a blindfolded monkey throwing darts at a newspaper could match your investment returns. This is not a joke. This is the shocking reality that Burton Malkiel reveals in his groundbreaking book, A Random Walk Down Wall Street. For decades, Wall Street has sold us the dream that with enough research, the right strategies, and perhaps a skilled broker, we can beat the market and get rich. Malkiel, a Princeton economist who has spent his career studying financial markets, proves this is largely an illusion. His book presents overwhelming evidence that stock prices follow what he calls a random walk, meaning they move in unpredictable patterns that make it nearly impossible to consistently outperform the market average. The concept of the random walk is deceptively simple, yet profoundly important. According to Malkiel, stock prices already reflect all known information about a company. When new information becomes available, prices adjust almost instantly. This means that tomorrow's price changes are essentially random, influenced only by tomorrow's news, which by definition cannot be predicted today. Think about it this way. If a stock's price could be reliably predicted to rise tomorrow, investors would buy it today, pushing up today's price until the opportunity disappeared. The market is like a giant information processing machine, with millions of participants constantly searching for profit opportunities and eliminating them almost as soon as they appear. This brings us to Malkiel's first major target: technical analysis. Technical analysts, also known as chartists, believe they can predict future stock prices by studying past price patterns. They look for formations with names like head and shoulders, double tops, and support and resistance levels. They draw trend lines and calculate moving averages, convinced that history repeats itself in predictable ways. Malkiel systematically demolishes these beliefs. He presents study after study showing that technical analysis performs no better than random chance. In one famous experiment, he created charts using coin flips to generate random price movements. Professional technical analysts could not distinguish these random charts from real stock price charts, and confidently identified patterns and made predictions based on pure randomness. The author explains that humans are pattern-seeking creatures. We see faces in clouds and meaningful shapes in random ink blots. When we look at stock charts, our brains naturally find patterns even when none exist. More importantly, even if certain patterns did predict future prices in the past, once these patterns become known, traders exploit them until they no longer work. But surely fundamental analysis must work better. This approach involves studying a company's financial statements, evaluating its management, analyzing its competitive position, and calculating its intrinsic value. If you can identify companies trading below their true worth, you should be able to profit as the market eventually recognizes their value. Malkiel acknowledges that fundamental analysis has more merit than technical analysis, but he shows it still fails to consistently beat the market for several reasons. First, analyzing companies correctly is extraordinarily difficult. Even professional analysts with access to company management and vast research resources regularly make spectacular errors in their earnings forecasts and recommendations. Second, even if you correctly identify an undervalued stock, the market might take years to recognize its value, or it might never recognize it at all. As economist John Maynard Keynes famously said, "The market can remain irrational longer than you can remain solvent." Third, and most importantly, Malkiel presents the efficient market hypothesis. In its semi-strong form, this theory states that stock prices rapidly adjust to all publicly available information. By the time you read about a company's strong earnings in the Wall Street Journal, or hear about a promising new product, that information is already reflected in the stock price. You are always competing against thousands of other investors, many of them professionals with better information and faster execution. The evidence supporting market efficiency is overwhelming. Malkiel presents data showing that professionally managed mutual funds, run by highly paid experts with enormous research budgets, consistently fail to beat simple market indexes after accounting for fees. Over a 15-year period, roughly 90% of actively managed funds underperform their benchmark index. Think about what this means. These fund managers are not amateurs. They have MBAs from top schools, sophisticated computer models, and teams of analysts. They work 60-hour weeks studying investments, yet the vast majority cannot beat a simple index that requires zero skill to replicate. The situation is actually worse than it appears because of survivorship bias. Mutual fund companies regularly close or merge poorly performing funds, making the historical record look better than reality. When you account for all the funds that disappeared due to terrible performance, the percentage that beat the market shrinks even further. Malkiel also exposes the tricks that make some fund managers appear successful. Many funds take extra risk to juice returns, which works until it does not. Others simply get lucky for a few years, attracting massive inflows of investor money just before their performance reverts to average or worse. The author shows that past performance has virtually no predictive power for future returns. So if neither technical nor fundamental analysis works reliably, what should investors do? This is where Malkiel's book transforms from a devastating critique into a practical guide. His solution is elegantly simple. Buy and hold low-cost index funds that track broad market indexes like the S&P 500. Index funds do not try to beat the market. They simply aim to match it by holding all or most of the stocks in a particular index. Because they do not require expensive research teams or frequent trading, their costs are minimal. While an actively managed fund might charge 1 to 2% annually, an index fund might charge just 0.05%. This difference in fees might seem trivial, but Malkiel demonstrates its enormous impact over time. A 2% annual fee differential, compounded over 30 years, can reduce your final wealth by almost 50%. In the investment world, costs matter enormously, because every dollar paid in fees is a dollar that cannot compound for your benefit. But Malkiel does not advocate putting all your money in one index fund and forgetting about it. He emphasizes the importance of diversification across different asset classes and geographic regions. A properly diversified portfolio might include US stocks, international stocks, bonds, real estate investment trusts, and even some commodities. The author provides specific allocation recommendations based on age and risk tolerance. Younger investors with decades until retirement can afford to take more risk and should hold primarily stocks. As you approach retirement, you should gradually shift toward bonds and other conservative investments to protect your accumulated wealth. This leads me to wonder, given all this evidence, what prevents you from abandoning the dream of beating the market and embracing index investing? Let us continue to explore Malkiel's practical recommendations. Malkiel introduces several important concepts for implementing an index-based strategy. Dollar cost averaging involves investing a fixed amount regularly regardless of market conditions. This automatically forces you to buy more shares when prices are low and fewer when prices are high, smoothing out market volatility. He also discusses rebalancing, the practice of periodically adjusting your portfolio back to your target allocation. If stocks have performed well and now represent 70% of your portfolio instead of your target 60%, you would sell some stocks and buy bonds to restore balance. This forces you to sell high and buy low, the opposite of what emotional investors typically do. The author addresses common objections to index investing. Some argue that markets have become less efficient due to the rise of index funds themselves, creating opportunities for active investors. Malkiel shows this argument lacks empirical support. If anything, markets have become more efficient over time as information spreads faster and trading costs have declined. Others worry about buying at market peaks. Malkiel presents historical data showing that even investors with terrible timing, who invested only at market peaks, still earned satisfactory returns if they held for the long term and stayed diversified. Time in the market beats timing the market. The book also covers behavioral finance, the study of how psychological biases affect investment decisions. Investors consistently overestimate their ability, trade too frequently, hold losing investments too long while selling winners too early, and chase last year's best-performing funds. Understanding these biases can help you avoid them, though Malkiel notes that even awareness does not guarantee immunity. Perhaps most importantly, Malkiel emphasizes that successful investing is not about intelligence or hard work. It is about humility, patience, and discipline. The smartest strategy is admitting you cannot outsmart the market and instead choosing to participate in its long-term growth through broad diversification and low costs. The implications of Malkiel's random walk theory extend beyond individual investors. He argues that the entire industry of stock picking, market timing, and active management is largely a waste of resources. The billions spent on investment research and the brightest minds attracted to Wall Street could be better deployed elsewhere in the economy. The core message of a random walk down Wall Street is both humbling and liberating. It is humbling because it forces us to abandon fantasies of discovering the next Amazon or perfectly timing market cycles, but it is liberating because it shows that building wealth does not require special skill or inside information. Anyone can achieve market returns simply by buying and holding low-cost index funds. Malkiel's approach will not make you rich quickly, but it will make you wealthy slowly and surely. By accepting market returns, minimizing costs, staying diversified, and maintaining discipline through market turbulence, you can achieve financial security without the stress and disappointment of trying to beat the market. The book's final takeaway is that successful investing is remarkably simple, but emotionally difficult. The strategy is easy to understand and implement. The challenge lies in maintaining conviction when markets crash, resisting the temptation to chase hot stocks, and accepting average returns when others claim to be getting rich quickly. If you found this summary valuable, please subscribe to our channel where we upload new book summaries every single day to help you learn faster and achieve more. And if this video helped you understand why index investing beats stock picking, please hit the like button as your feedback helps us know which books to cover next.